The S&P 500 fell more than 20% from its record set in January, while the Dow is 15% below year-to-date. The Nasdaq has fallen more than 30% since hitting a record in November. There is no doubt we are already in the bear market. Is now a good time to invest? Before we answer the question, let's have a look on historical data first. In the past 5 decades, the S&P 500 has entered a correction 26 times, which means the market declines by 10% or more only about once every 1.9 years. Market corrections during bear markets are more severe. In the past 50 years, the S&P 500 has entered a bear market 7 times, which means the market drops 20% or more about every 7.1 years. This chart shows the start date, trough date, peak loss, and the number of days it took the S&P 500 to reach a bottom for bear markets in the last 50 years. The S&P 500 fell 41.4% on average during bear markets over the last 5 decades, and it took an average of 472 days to reach a bottom. The data appears scary and pessimistic, but if we look at the data of the bull market, we can see that the S&P 500 rose 258.8% on average during bull markets over the last 5 decades, and it took an average of 2,510 days to reach a top. The stock market always rises higher than its previous peak after the correction. In other words, bull markets run higher and last longer than bear markets. So, the question is, will this time be the same, or has the catalyst for the bull market of the previous 10 years disappeared? We need to understand what led to the bull market over the previous decade in order to figure out the solution. Many investors think the reason that caused the bull market after 2009 was because of the total factor productivity increase. However, if we look at the graph for the last 30 years, the productivity for the 80s to 90s was massively increased. But the pace was slowed down for the last decade. There was only 5% increase for 10 years. Basically, we may state that the last bull market was not sparked by a rise in productivity. What then is the driving force behind the bull market? There is no doubt that the Fed's monetary policies contributed significantly to the bull market. This monetary strategy also includes QE, or quantitative easing, in addition to the low interest rate. What makes this monetary policy so powerful and capable of driving the stock market higher? The bank rate will be reduced first. The bank rate is the interest rate charged by a central bank on its loans and advances to commercial banks. Many businesses are eager to lend more money because of the low interest rate. And as a result, they will repurchase their own stock. To raise the company's valuation, the majority of businesses choose to buy back their stock. In addition, the corporation will be more eager to invest in capital expansion now that it has more money. The corporation will make more money and improve the value of its assets with the capital expansion. These all contributed to a positive increase in the stock market. In short, we might say that the stock market's rise is depending on credit. The more money a corporation lends, the more capital will be expanded, and the more development will occur. What happens if the era of low interest rates ends? The majority of Federal Reserve members predict that interest rates will stay above 3% until 2025. Interest rates haven't gone up more than 2.5% in the past 15 years. Most businesses won't be able to extend credit due to the high interest rates, which will make the stock market unable to remain bullish. Therefore, the question is whether the interest rate will eventually drop to 1% or less. Some investors believe that the interest rate will eventually decline, while others have a contrary belief. So, inflation is the major factor for some investors to believe that interest rates won't decrease significantly in the future. They were convinced that the reason the interest rate managed to remain low for the past 10 years was due to the absence of high inflation. They believe the Fed won't be able to keep interest rates low because inflation is strong and not expected to decrease anytime soon. Therefore, What is the reason that caused them to think inflation will not going away, and why there is no high inflation in the past 10 years since the interest rate was so low? Supply chain is one of the main reasons behind this incident. Or to be more specific, the factor influencing how companies find their own manufacturer or supply chain has changed. Cost and efficiency were the two key considerations for businesses in the past while searching for their manufacturer. They often look for manufacturers with lower costs and more efficiency, and most of the factories from China meet these requirements. These factories enable the global goods to remain affordable. The graph shows the inflation of the goods and service. We can see that the inflation of goods stay low in the past 10 years, and this mainly came from the contribution of productivity of China. However, now the companies will prioritize stability over manufacturing costs, especially after the pandemic. Due to China's stricter epidemic prevention policy, the majority of manufacturers are unable to operate, which results in significant losses for U.S. companies. So, the U.S. companies will find other alternative manufacturer which not coming from China, and this will cause the cost of goods become higher, which lead to increase in price of the products. This will make the inflation stay high and cause the Fed not able to lower the interest rate. On the other side, there are some investors have totally different views. They think that the low interest rate will return. The main reason is U.S. government have no reason to not lower the interest rate. They have experienced the advantages of the low interest rate and will not give up the benefit. Low unemployment rate, high capital expansion from companies, and steady economic growth are all advantages that only exist during periods of low interest rates. The low interest rate also saved the economy from 2008 financial crisis. So, the investors expect Fed will reduce the interest rate when the financial crisis hits. Beside that, they believe that the US won't be able to sustain high interest rates for a very long period. The US economy is not as productive as it once was, and if interest rates remain high for an extended period of time, US businesses won't be able to expand, causing the economic stagnation. Personally, I lean more toward the idea that low interest rate phase will occur in the future, leading to a bull market. I believe that other developed nations with lower costs and more efficiency, particularly those in Southeast Asia like Vietnam, Thailand, and Indonesia, will be able to resolve the manufacturing cost issue. As a result, I believe the likelihood of interest rate cuts in the future is rather strong. The only question is whether inflation will decline first or whether the economy will collapse to the point where the Fed must decrease interest rates in order to save it. This still remains to be seen. If you have other opinions, let's comment below. Please help to like and subscribe.